Good morning and welcome to this presentation of Castellum's Q2 report. My name is Christopher Strandbeck, Head of Investor Relations. There will be a Q&A session in the end of the webcast. If you'd like to ask a question by phone, please dial pound key 5 on the telephone keypad and ask your question. Let's start. Please go ahead, Joachim.
Thank you, Christopher, and I say also good morning and welcome to this presentation of Castellum's Q2 results. In June, we announced our first larger acquisition for quite some time. We got the opportunity to acquire a high-quality portfolio of assets in Uppsala, Örebro, and Linköping, with a total property value of approximately 1.7 billion SEK. We will look into this acquisition in more detail later on in the presentation, of course. In addition to the acquisition, we have continued to invest in our existing properties and have started a few more projects, as well as continued to increase our stake in Entra. We have a strong financial position and have capacity to continue to invest in attractive opportunities. During the quarter, we have refinanced bank loans of 10 billion SEK, continuing to increase our debt maturity and at the same time achieving a cost reduction through lower credit margins. On Friday this week, the 18th of July, we will hold an extra general meeting of shareholders in Stockholm, where our shareholders will decide upon a new board of directors. As usual, we have this short overview for those of you that do not know us that well. We're one of the largest listed property companies in the Nordic region, with a property value of approximately 159 billion, including our share in associated companies, which are Entra and Halvorsäng. We focus on three segments: office, which is our largest segment; logistics, which include warehouses and light industry; and public sector properties. The property portfolio is located in attractive growth regions in the Nordics, and we have a yearly contract value of approximately 9.5 billion SEK. Castellum is a fully integrated company with local hands-on presence where our assets are located. In all of our markets, we have boots on the ground, and customer activities such as leasing, tenant improvement, relationships, etc., are all done locally. As can be seen from this slide, our property portfolio is located in Nordic growth regions. 74% is located in Nordic metropolitan areas. That means urban areas with at least 1 million people. And the remaining 26% is in growing regional cities in Sweden. The largest market measured by property value is Stockholm, followed by Gothenburg and Malmö. In addition, we have a decent portfolio in Copenhagen and Helsinki, as well as well-positioned and profitable portfolios in a number of Swedish regional cities. These regional markets have proven strong resilience and even rental growth during the last time's downturn. We have a solid market position in our regional markets, where we are number 1, 2, or 3 in each of them. That makes us relevant for tenants and the city's councils. This is our fully owned and consolidated portfolio, and as mentioned, we have also a 37% stake in Norwegian Entra, and our share of Entra's portfolio is approximately 23 billion NOK in value. Turning over to the most important part of our business, our tenants. The tenants represent a cross-section of Nordic business and authorities, and our exposure to individual tenants is low. Our 10 largest tenants represent less than 15% of our total contract value, and no tenant generate more than 2.8%. We have a strong tenant base, with many of our larger tenants being publicly funded operations. 26% of Castellum's total contract value stems from public sector tenants. The largest tenant is the Swedish Police Authority, with a contract value of 2.8% of our total. The remaining average length of our contract is 3.6 years. I'd first like to apologize for a slide full of text, but we wanted to give you a short update on certain larger tenants that has caused some media attention. First, we have ABB. It's an important tenant to us in Västerås. 2 years ago, they announced that they will build a new campus for their robotics business, that is industrial areas. We have, during the quarter, prolonged the robotics rental agreement to the end of 2027 and to mid-2028. But ABB has also given us a waiver of possession protection. The yearly rent for that part of the contract stock is approximately 0.6% of our turnover. Then AFRY, unfortunately, they have announced that they will be moving to another property. The yearly rent for that is less than 1% of our turnover, and the contract ends in last of September 2028. So it gives us plenty of time to work on that vacancy. And finally, Northvolt. As you know, the bankruptcy hurt our net leasing in Q1. For clarity, we reported 100% as negative net leasing in Q1, but we have been paid for part of the premises also for Q2. More importantly, we are optimistic about finding customers for the premises, and one way it could be solved is if the bankruptcy administrator finds a buyer for the entire Northvolt operation. So, summarizing the first half year, results compared to the same period last year is negatively affected by the fact that we have sold standing and yielding assets during last year, as well as been hurt by higher vacancies. In addition, income from property management is negatively affected by slightly higher financial costs. We will look into these figures in more detail in the presentation. The net leasing for the second quarter of this year is +2 million, after a first quarter with a disappointing net leasing figure. So for the whole period, this year is -182, as stated in the report. The occupancy rate stands as 90.3%. Our net investments of 2.8 billion back on track, and we will of course continue to generate income from those investments going forward. The acquisition of 1.7 billion was finalized on the last of June, and hence it will start to contribute the next quarter. Short term, the timing of our asset rotation has been punishing our income growth, but long term, we're convinced that this asset rotation into more high quality properties will be very positive for Castellum. Just a quick overfly over the P&L. As mentioned, total income decreases and divestments has affected income negatively. Good cost control with a reduced property cost. We got a good contribution from Entra this quarter, up more than 1 billion compared to last year. And summing up the report, we have property income of minus 8.7%. Jens will cover all this in greater detail. Over to you, Jens.
Good morning, everyone, and thanks, Joachim. Looking at development of income, the like-for-like portfolio income increased by 5 million, equivalent to 0.1%. The change in the like-for-like portfolio is mainly driven by indexation, but offset by high vacancies. The direct property cost for the like-for-like portfolio increased by 14 million, equivalent to 1.2%. Direct property costs decreased at the beginning of the year due to the warm winter, but increased in the second quarter, primarily due to the higher rental losses, which increased by 17 million from 8 million to 25 million. However, overdue receivables still on low levels. Central administrative and property administrative costs increased by 3 million, equivalent to 1%. However, the increase in administrative costs are lower than salary indexation due to our ongoing cost review. On an aggregate level, NOI decreased by 185 million, with divestments, increasing vacancies, and one-off insurance claims recorded during second quarter previous year as key drivers. Please note that current portfolio is still not in the income numbers. Looking at renegotiations, prolongations, and net leasing, renegotiation corresponding to an annual rent of 135 million were conducted during the period, with an average positive change in rent of 1%. Limited investments on average to secure the renegotiated leases. Additionally, contracts with an annual rent of 801 million were extended during the period with no change in terms, equivalent to 53% of total lease stock up for renegotiation. We are, of course, not satisfied with the net leasing in the first quarter. Several larger terminations and a single large bankruptcy led to a net leasing result of minus 184 million for the first quarter. In the second quarter, net leasing has stabilized and amounts to 2 million. We have signed several large leases in our projects, and our gross leasing is at a high level, however, suffers from a large portion terminations and more bankruptcies than average. The economic occupancy rate amounts to 90.3%, a decline of 1%. The decline is attributable to increasing vacancies corresponding to 0.6% and a general review of vacancy rents, which contributed in additional 0.4%. Several large leases has been signed during the second quarter. One of them in Gothenburg, Mölnlycke, we have leased out an entire building for 500 co-workers to Saab on a long lease. The building will be adapted for Saab's needs and completed in June 2026. The existing tenant will move to a smaller building, also owned by Castellum, and the total deal generates 17 million in positive net leasing. We also have some positive development in Copenhagen. Existing tenant Clever that had a 12-month running lease was renegotiated to a 6-year contract with an increase of 500 square meters. Total lease of 6,600 square meters, unchanged rent per square meter. In Jönköping, now Verket is fully leased out. The Swedish Police Authority expands and leases an additional 7,700 square meters on a 6-year lease. Build start in fourth quarter 25 and move-in start of 2027. Yearly rent value 23 million. Also in Gothenburg, our tenant Nitec, after merger with Semcon, leases the entire building. Total area 9,288 square meters. That will host 500 co-workers with a rental value of 27 million per year. The deal proves that we succeed when we stick to our clients and support them in their development and offer modern office in attractive locations. Moving over to rental income and net leasing. As mentioned, a slight positive net leasing due to quarter. Income continues being more stable over time, however, affected negatively by 2 years of divestments and a general slowdown in the economy. Acquisitions, ongoing and new projects will together grow rental income over time. Looking at property values. During the period, Castellum has written down property values with approximately 1.15 billion, equivalent to minus 0.8%. The value change is partly driven by the default of Northvolt, the fact that Offer will leave approximately 24,000 square meters in Solna, and generally lower cash flow expectations in our valuations due to a downward pressure on rental levels and/or increased TIs to uphold lease levels in some of our markets. The valuation yield is in all essence the same as the first quarter 2025 at 5.62%. Our projects continue to show positive value add. The acquisitions of 5 properties in Uppsala, Örebro, and Linköping from Quorum during the period was concluded at the discount market values, which has been taken into account in the second quarter valuation. The investment volume in the Swedish real estate sector ended up to approximately 36 billion in the second quarter 2025, compared with 31 billion in 2024, according to Cushman and Wakefield. Segueing into the financial side of the business, as Joachim mentioned, we have refinanced approximately 10 billion of secured debt during the quarter with an annual cost saving of around 20 million SEK. The strict majority of the refinancing was on a 5 or 10-year tenor. Spreads on new bank loans are in the range between 120 to 140 bps. Financial market is very good right now. Current spreads in the domestic market for a 3-year bond is at around 95 bps, and for a 5-year bond around 130 bps. European market indicates 10 bps wider. Spreads on the banking system generally somewhat lower than in the bond market, especially in the longer end. We received a Ba2 rating with stable outlook from Moody's during the quarter, and we also carry a BBB stable rating from S&P. We have increased the use of commercial papers during the quarter to reach almost 3 billion, up from around 0 not too long ago. Current credit spreads of commercial papers is only 45 bps on a 3-month tenor. Relatively cheap money and good for our cash management. Average interest rate currently at 3.2%, down from 3.3% during the first quarter. We see a potential to further reduce the average interest rate in our debt portfolio in 2025 by refinancing loans and bonds on better terms. However, somewhat mitigated by some really well-priced swaps that will expire during the end of 2025 and throughout 2026. Loan to value now at 36.7%, somewhat increasing during the quarter due to acquisitions of the Quorum portfolio and Entra shares acquisitions. ICR currently stable at 3.2 times, comfortable headroom against policy levels of 3 times. Average debt maturity currently at 4.6 years, including refinancing that was closed in the beginning of July. The average debt maturity is close to 5 years. Average fixed interest term is stable at 3.6 years. We have entered new interest rate swaps during the quarter, totaling 1.9 billion. During the quarter, costs related to FX fixing of Entra have impacted financial net by approximately 27 million, a direct effect of historically high interest rate differential between Norway and Sweden. Over to you, Joachim.
Thank you, Jens. Well, Castellum works towards clear sustainability targets in the short and the long term to contribute to a sustainable development. Energy efficiency was -6% in the like-for-like rolling 12 months normalized portfolio. I'm very proud of the organization. We are actively engaged in reducing our climate impact through enhancing energy efficiency, which is the most effective way to conduct sustainability work. 68% of the property value is sustainability certified, and 23% of our total electricity consumption is self-generated. Investments and transactions during the first half year. Quality is one of the most important drivers, and rotation of our portfolio is an integral part of our value creation. Last year, we sold assets, and as Jens mentioned before, that has significantly affected our income. And we have since reallocated funds to projects, but now also to acquisitions. The net investments of 2.8 billion SEK is in our fully owned portfolio. That does not include the investments we've done in Entra. We've invested 1.3 billion, almost everything in projects, including new construction as well as extensions and renovations. And we have acquired for, as Jens mentioned, 1.7 billion. And then, in addition to this, we have also acquired shares in Entra, a total of 383 million in Q1 and 400 million in Q2, which translates into an indirect property acquisition of more than 2 billion SEK. This way, we are heading towards a full year of 2025 that may be close to a record year, save for the acquisition of Kungsleden. We firmly believe that being counter-cyclical is the right thing to do in this market. We have the financial strength and we have the internal drive in the management to make the best of all opportunities. We have, of course, ongoing projects, 6 of the largest ongoing projects and 5 to be started. Larger project means investments larger than 15 million SEK. It's a mix of metropolitan areas and regional cities. The average occupancy rate for the ongoing project with a total, the average occupancy rate is 93% for the ongoing projects, and we have a total rental value of 171 million. Total investment volume is 3.8 million, of which 2.5 remains to be invested. During Q2, we have decided to start new construction of 22,000 square meters of logistics in Burlöv in Malmö. The investment volume is 291 million in total, of which 238 remains to be invested. That represents 0.18% of our asset value. We have a positive view on the micro locations in the local markets for both logistics and warehouses. As mentioned in Q2, we have continued to acquire shares in Entra and currently hold 37%. In total, this year we have acquired for 783 million NOK at an average share price of 118.72 NOK, or approximately 30% discount to Entra's net asset value. We think acquiring shares at these levels is a good long-term investment for us, and also Entra's last report last week also showed strength again. As mentioned several times before in this presentation, in June, we acquired a high-quality portfolio of assets in Uppsala, Örebro, and Linköping. The total property value is 1.7 billion, and as you know, we have a very strong market position in each of these three markets, and with this acquisition, it strengthens even further. We can add these properties without any new employees, which makes great economics. It's a good mix of strong cash flow and a few opportunities in terms of some vacant space for our local staff to work with. The location of all the properties is great. It's right in the city center, very close to the train station, and as can be seen from these maps, very near the properties that we already own. The leasable area is 56% office and 35% hotel. The largest tenant is Elite Hotels, and the second largest is the County Administrative Board, i.e. Länsstyrelsen. It's a 7.1-year vault, and the rental value is 127 million, and the initial NOI is 93. Here's some pictures of the properties in Örebro, and they are actually situated right next to our existing building, forming a very handsome cluster of asset right by the central station in Örebro. And then some pictures from the properties in Uppsala, and just to mention that the notice from Länsstyrelsen to move into another of our assets in Uppsala has been factored into the acquisition price, because that was already known to us at least. So, key takeaways. There's plenty of global uncertainty, and the Nordic markets are not really accelerating as we want. There's still fundamentals for the Nordic economy to pick up, but it's more difficult to predict the development. The rental market is still stable in our regional cities, however, more challenging in the metropolitan areas, and especially for office in Stockholm. After a disappointing Q1 negative net leasing figure, at least we're back on positive territory for this quarter, which we are very happy about. Our rock-solid financial position gives us ample of room to maneuver, and it's still very good and even improving financing options. We are happy for the 10 billion SEK refinancing of bank debt in this quarter with improved credit margins. Finally, we are so satisfied being able to close the 1.7 billion acquisition and adding these high-quality properties to our portfolio. As mentioned before, we have an extra general meeting on the 18th of July, and our interim report will be for the third quarter will be on the 23rd of October. Thank you.
Thank you, Joachim and Jens. Now it's time for questions. So if you'd like to ask a question by phone, please dial pound key 5 on your telephone keypad and ask your question. The first question comes from Lars Norrby, SEB. Go ahead.
Well, good morning.
Good morning.
Starting off with value changes, obviously you had significantly higher negative value changes in the second quarter than in the first quarter. I think I've heard some explanations here, AFRY being one of them. But Northvolt, you took the full hit to the net letting or net leasing number in Q1, but did still Northvolt have a negative effect on values in the second quarter? And what else is there out there explaining the higher level in Q2?
Hi, Lars, Jens here. The full effect on the valuation was taken during the first quarter, so the majority of the value change is located in the Stockholm region. Some 200 million relates to AFRY, and 8 out of the 10 largest negative value changes has been seen in the Stockholm market.
And there's also a 0.4% change, which is related to the fact that we have done an overview of our vacancy rents.
Okay, very good. Thank you for that. Turning to net leasing, obviously it returned into black figures in the second quarter. You mentioned a number of new leases, the Swedish Police Force, Saab, Scandic, Nitec. So what's on the negative side? Was it the renegotiation or with the ABB Robotics, or what's the explanation for that it still comes in close to zero?
There's some significant terminations that happened during the quarter, but I mean there's quite a few of them.
No specific ones that should be mentioned. However, Stockholm region and Öresund has been more severely hit than other regions.
Okay, and then just a final question. You mentioned that AFRY is moving, but there's still a tenant. Hasn't affected your net leasing figures yet.
No, we have not received the termination for that premises, and they're still bound by the contract to last of September 2028.
So best guess, when will that termination come and hit the numbers?
We actually don't know, but I mean, in all fairness, we know that they're moving. So from a management point of view, we're already working on how to fill that fantastic building right next to the highway with a very good location. So from a practical point of view, I realize you need to put that into your Excel sheet, Lars. But from a practical point of view, we're already working as if it was terminated.
And final one then, just in terms of contract value, how much is it? You mentioned it's as a share of total turnover, but what is it in million roughly? Can you give a range?
I mean, it's the annual rent is 93 gross, and then you can multiply that until the end of December 2028.
Got it. Thank you.
Thanks.
Thanks. As we take one question from the chat function from Martin Cartman. Thank you for the presentation and taking my question. Are there any upcoming nearby lease maturities where you believe the risk of the tenant vacating is higher? You have negotiated 2 leases with ABB Robotics. Are there more with a specific tenant that will need to be renegotiated?
Not that we have received notice of, but in a portfolio the size of ours, there's always both big and small business discussions going on. So there will be renegotiations and terminations but there will also be new leases signed. The market is improving, but discussions still take very long time, and we don't foresee that to change anytime soon.
Next question from Jonathan, Goldman Sachs.
Good morning. Thanks for taking my question. It's still a bit early on the hybrid, but just wanted to ask about your thinking there as to whether you refinance that early or you're planning to let it run until the 5-year period. Thanks.
Good question. Of course, we are looking into the hybrid. We are in discussions with our financial advisors how to handle it, and currently the pricing is at around 5.75%, higher than what it's running at today. So in all fairness, to keep it till the first call date could make some sense if you only look at it from a cash flow perspective. Looking at it from also a risk angle, it could be a good idea to actually proactively handle it beforehand, considering the EGM and the situation. Any proactive move haven't been possible during the last few months. Let's see how things turn out after the summer. Maybe we will come back and try to refinance it, but nothing has been decided yet.
Okay, thanks.
And that was actually the last question for today. So thank you all for listening.